The Oracle of Omaha has struck again. Warren Buffett of Berkshire detonated an earthquake in the financial world, and the tremors reached Wall Street when news broke that the company sold off nearly half of its Apple holdings. Hathaway reduced its Apple holdings as unexpectedly as a snowstorm in July.
This morning it shows that Berkshire sold another 115 million shares of Apple in this last quarter.
We're talking about an almost 50% share reduction, from the lofty 790 million to the still impressive 400 million. This isn't some trimming, it's a hedge cut. This is the reason why he did it. Warren Buffett is noted for his great faith in the stocks he buys. Unlike everyone else, he invests for the long run, often holding them for what seems like an eternity. And so the question everyone should now be asking is, what's cooking in this investment titan's mind? Well, let's look at what's going on at Apple nowadays. Entering AI with Apple Intelligence could, in fact, be the thing that jumpstarts a slowing iPhone market, tempting consumers to upgrade their devices. Of course, several large problems counteract this potential upside. With millions of folks still rocking iPhones that are older than some college students, there is a huge potential market looking for upgrades. And let's not forget that shiny new satellite feature coming to iMessage. It's like rocket fuel for what's already a blazing fire. Imagine being in the middle of nowhere with a dead cell signal, yet your iPhone still lets out an SOS. Those are some pretty good upgrade reasons. Combine that with the promise of new features and improved performance that usually come with newer models, and Apple might just have a winning formula on its hands, just like it has every other year. Unfortunately, everything's not going according to plan. The company has been wrestling with declining revenues in the crucial Chinese market, historically its growth driver. With increasing regulatory hurdles, Apple is put in a complex operating environment. Also, there is no really revolutionary product or service anywhere to glance at other than the potential of Apple Intelligence. Admittedly, Apple is taking its time with groundbreaking revolutions, but according to experts, it'll take a while. So except for Apple Intelligence turning out to be something special, the company isn't going to post any meaningful revenue growth and will be held back to low single-digit growth. Apple has been a cash cow for years. Since Buffett really started chomping up Apple stock around 2016, Berkshire Hathaway has laid out a cool $40 billion. Boy, has it paid off. The stock soared, giving Berkshire nearly an 800% return. The thing is, the best investments can get quite pricey. Everyone's scratching their heads with Warren Buffett's recent decision to dump nearly half his Apple stake from Berkshire. According to filings published on August 3, 2024, Buffett ended up dumping around 390 million Apple shares, which amounts to nearly half his holding in the tech giant. Was this sell high, or was the old wizard sensing something? Well, don't think this means that Buffett and Apple are breaking up just yet. Dramatic in its pure form, the scale of Berkshire's divestment is. There is a lot more to it when zoomed out a bit. Even after shedding nearly half its stake, Apple remains the unquestionable cornerstone of Berkshire's investment empire. This isn't the first rodeo for either Buffett or Apple. Earlier this year, he quietly shed a significant chunk of his Apple holdings, reducing Berkshire's stake from a dominant 49% to a still impressive 44%. But the real bombshell came in the second quarter. He practically halved the position again. Now Apple, once the undisputed king of Berkshire's portfolio, holds a more modest 28% throne. Instead, Warren Buffett's Berkshire Hathaway is sitting on a mountain of cash, a stunning $277 billion to be exact. This is an unprecedented sum, even for an organization the size of Berkshire. What is he planning to do with this record war chest? To put this into perspective, Berkshire sold a whopping $75.5 billion worth of stocks in the second quarter alone. Apple took a significant hit, as did Bank of America. Despite these divestments, the above-mentioned 5 companies, Apple, Bank of America, American Express, Coca-Cola, and Chevron, still make up a hefty 72% of Berkshire's overall value. These dramatic changes, however, haven't deterred Buffett from remaining an unabashed Apple fanboy. His public praise for the company, placing it alongside American Express and Coca-Cola, is as relentless as the rising sun. So what's going on? Though the Apple divestment was eye-catching in its own right, the simultaneous reduction in Bank of America shares puts things into proper perspective. It could be that Buffett is hedging in both of these financial giants while offloading billions. After all, he may need to rebalance the portfolio, cut concentration risk, or just free some capital to make acquisitions. Or he's just capitalizing on inflated valuations to lock in profits. It's an interesting contrast that Warren Buffett has been buying back Berkshire Hathaway shares while selling other equities simultaneously. This may indicate confidence in Berkshire's intrinsic value and future prospects, even as he reassesses his external investments. Aggressively repurchasing shares of Berkshire Hathaway, Buffett is communicating confidence in the company's future without reservation. Such a bold move would further suggest that he feels the stock is undervalued, and unparalleled investment opportunities are available through Berkshire Hathaway. Here is a strategy that does three things: increases earnings per share for existing shareholders, represents financial strength, and possibly lightens the tax burdens of the company. It's the classic Buffett move, buying what he knows best. Why the apparent inconsistency with buying back Berkshire shares but liquidating other holdings? The veil of mystery over Buffett's recent moves is thick. Financial experts have their theories, but the truth lies in the words of the man himself. Buffett has always been candid, but often cryptic. His public statements can be useful inputs, especially during Berkshire Hathaway's annual meetings. And it was during one of these recent meetings that Warren Buffett was very straightforward about how Apple remained one of Berkshire Hathaway's top picks, and it would likely be their biggest investment for quite some time. So what's the story? Well, the Oracle of Omaha is making another significant bet on cash, where he feels comfortable increasing Berkshire's cash reserves even after selling off huge chunks of other stocks. The current market conditions and the general global economic outlook seem to make holding cash so very attractive to Buffett. According to the latest government data, the USA is experiencing slowing job growth as well as the highest unemployment rate since October 2021. Then there's the Ukraine-Russia conflict and the growing conflict with China threatening the stock market. And that's exactly why some financial analysts predicted multiple Federal Reserve rate cuts in September. And so Warren seems cautious, merely waiting for better opportunities to emerge from investments. Buffett's decision to hold cash while he swings wildly in the stock market is simply a case of intelligent investing. He has kept a huge portion of Berkshire Hathaway's assets in short-term treasury bonds and is earning interest without undue risk. During the meeting on May 4th, 2024, he said, "We'd love to spend it, but we won't spend it unless we think we're doing something that has very little risk and can make us a lot of money." He also said that he was cautious of the 21% federal tax rate on the gains, which would probably grow in the future, according to him. It's a strategic move that will help Berkshire preserve its wealth, waiting for better opportunities. It is quite reasonable to hold cash in hand with the seesawing up and down of the stock market recently. Maybe that's why he also dumped more than $3.8 billion in shares in Bank of America, its second largest stock holding, in mid-July. It's like going to a flea market. He is looking for that hidden gem, that undervalued stock that the market has passed by. But he's also enormously patient. If he can't find something that meets his strict criteria, he's perfectly happy to wait on the sidelines with his cash. Warren Buffett is famously good at sniffing out undervalued companies. Historically, he has had a raft of investment opportunities to pick from, but the current market landscape is different. In fact, Buffett himself acknowledged that he had not recently found too many investments that had turned his crank. It's a bit like a skilled fisherman who's used to catching plenty of big fish, but now finds the pond is unusually quiet. While he has no problem continuing to hold cash and making returns through treasury bonds, his long-term goal is to put that capital to work in promising businesses. Until then, Buffett doesn't mind waiting. Warren Buffett's reluctance to invest much in the present market could be taken as a cautionary flag in its own right. When an investor of his standing finds it hard to find any compelling opportunities, this means that valuations have had a pretty good stretch. History is full of incidents where high valuations have been followed by a correction in markets. While the Buffett stance does indeed flash a few cautionary lights, it doesn't predict the exact timing of the crash. The key for investors is a long-term perspective. Build a well-diversified portfolio and stay invested, rather than panicking about the situation. Regular rebalancing and staying updated about market trends help in mitigating risks. Remember that some of the best investors are those facing setbacks. It is about remaining disciplined and making informed decisions. Although the insights from Buffett are invaluable, it's important not to forget the context. Being at the helm of a gigantic conglomerate such as Berkshire Hathaway shapes his investment decisions in ways that are different from individual investors. Pay attention to the principles, not the specifics. The emphasis by Buffett on value investing, long-termism, and discipline are just fundamentals applicable to any portfolio size. And so there you have it. Buffett has been making waves. Apple has some cool new tricks up its sleeve, and the market is a roller coaster. All in all, it's a real wild ride. But that's pretty much what can be expected of the investment world. The bottom line, not all your eggs should be in one basket. Spread your money around, do your homework, and don't get too entangled in what the big boys are doing. In any case, your financial journey differs from theirs. Hence, track what works out for you.